All right, so you bought a stock in February, and now you're down about 30%, and you're not sure what to do. You think it'll still go up as we get towards the summer, so you don't really want to sell it, but it's a big loss, and it's kind of bothering you. So what's the plan? Well, there's something you can do. It's called tax harvesting. What you do is you sell your shares today, you wait 30 days, and then you buy it back after the 30-day wait period, and now you get to count that loss against your taxes. And then once you buy it after that 30 days, you're starting fresh, and then any gains from that point on would be normally taxable. There's a kind of a second aspect to this you can do. If you have a Roth IRA, and the original stocks, now they have to be in a taxable account, so they have to be in a traditional IRA or they have to be in a brokerage account in order to get the tax harvesting rule, because a Roth does not allow you to sell for a loss because of the way it's configured. But if you take a stock that was in your taxable account, you're down 30%, you sell it today, you wait till, say, the middle of May, you buy it back in your Roth, now maybe once it starts recovering, all those gains are non-taxable because any gains in your Roth are not taxed. So it's kind of a nice strategy if you do have some losses from that mid-February top of tech, and then we had kind of a March meltdown. If you still have some stocks that you're down big on, it's worth maybe doing this tax harvesting. Just sell them, buy them back, 30, 35 days later. If you can, buy it back in your Roth, so then any gains will be non-taxable. It's a good strategy moving forward, especially if you've made money on other stocks and you don't want to pay a bunch of taxes in 2021 for this calendar year. It's worth considering. I've already done it with a few stocks myself, and I think it's something to keep in mind.